Today we're going to look at the company Grupo Aeroportuario del Sureste, headquartered in Mexico and traded on New York Stock Exchange under the ticker ASR. Please stay tuned for the important disclosure information at the conclusion of this video. The history of Grupo Aeroportuario del Sureste began in 1998 as a central pillar of Mexico's strategy to modernize its aviation infrastructure. Founded as a wholly owned government entity during a period of nationwide privatization, the company was awarded 50-year concessions for 9 airports in southeastern Mexico, with the world-famous Cancun International Airport serving as its crown jewel. A major turning point arrived in September 2000, when ASUR made history as the first Mexican airport group to trade on public markets with a dual listing on the Mexican Stock Exchange and the New York Stock Exchange. This transition to public ownership was finalized in 2005 when the Mexican government sold its remaining stake, making the company entirely privately held. In recent years, ASUR has transformed from a regional operator into a diversified international leader. The group expanded into Puerto Rico in 2012 by winning the bid for the San Juan Airport and later entered the South American market by acquiring a majority stake in Colombia's Airplan. Most recently, in late 2025, the company aggressively expanded its footprint, acquiring URW airports to manage retail programs at major U.S. hubs like LAX and JFK, and signing a massive deal to acquire CPC Aeroportos, adding 20 airports across Brazil and other Latin American regions. Grupo Aeroportuario del Sureste, or ASUR, operates under a dual revenue business model that transforms traditional infrastructure into a sophisticated commercial engine. As a leading airport concessionaire, the company's primary income is split between regulated aeronautical services and high-growth non-aeronautical commercial activities. Aeronautical revenue is derived from essential operations, including landing fees, aircraft parking, and passenger charges, which are governed by long-term government concessions that provide predictable, inflation-protected cash flows. However, the company's strategic focus has increasingly shifted toward its non-aeronautical segment, which leverages passenger dwell time to generate revenue from retail, duty-free shops, restaurants, and parking. By positioning its airports, particularly its flagship hub in Cancun, as premier retail and leisure experiences, ASUR captures significant spending from a consumer base dominated by international tourists. ASUR's customer base is highly diversified, ranging from major global airlines like American Airlines and United to low-cost carriers and millions of individual leisure travelers. While Mexico remains its core market, the company has aggressively pursued international expansion to mitigate regional regulatory risks. It now commands a significant presence in Puerto Rico, managing the San Juan Airport, and Colombia, where it operates 6 regional airports, including Medellin. This Pan-American footprint was recently supercharged by the massive million acquisition of CPC Aeroportos, which added 20 airports across Brazil, Ecuador, and Costa Rica, firmly establishing ASUR as a dominant multinational infrastructure manager. The 20-year financial journey of Grupo Aeroportuario del Sureste, ASUR, is a testament to the power of a dual-engine business model that balances regulated flight fees with aggressive commercial monetization. When we look at the data in Mexican pesos and strip away the non-cash construction revenue, we see a company that has not just grown, but has undergone a total structural transformation. In the early years of this analysis, from 2006 to 2011, ASUR was a stable infrastructure utility, with its revenue closely tied to the steady increase of tourism in the Mexican Caribbean. During this phase, aeronautical revenue provided the overwhelming majority of the company's income, serving as a reliable foundation that allowed the group to survive the 2008 global financial crisis. A dramatic inflection point occurred in 2017 when ASUR's total revenue surged into a new stratosphere. This jump was fueled by the internationalization of the portfolio, specifically the consolidation of major assets in Puerto Rico and Colombia. By moving into different geographic markets, ASUR de-risked its dependency on the Mexican government's regulatory cycles and tapped into the rapid growth of South American aviation. This strategic pivot is clearly reflected in the jump to 8.7 billion peso in 2017, marking the beginning of the company's transition from a regional operator to a multinational airport giant. The most extraordinary part of ASUR's history is found in the post-pandemic era from 2021 to 2025. While the 2020 pandemic caused a temporary contraction, the rebound was unprecedented. By 2022, revenue had essentially doubled over the previous year, reaching 21 billion peso. This was driven by a unique, perfect storm, a massive surge in international traffic to Cancun, which remained one of the few global tourism hubs to stay open throughout the crisis, and a dramatic increase in commercial revenue per passenger. ASUR spent this period aggressively upgrading its terminal retail, duty-free shops, and premium services, allowing it to capture a larger share of the passenger's wallet than ever before. By 2024 and 2025, the company reached its current massive scale, with total operating revenue climbing to over 28.4 billion peso. By acquiring the rights to manage retail programs at massive U.S. hubs like LAX, JFK, and Chicago O'Hare, ASUR has effectively turned non-aeronautical income into a near-equal partner to its traditional flight fees. The financial history of Grupo Aeroportuario del Sureste, ASUR, over the last 20 years reveals a staggering ascent from a regional concessionaire to a multinational infrastructure titan. This period, stretching from 2006 to 2025, showcases the company's ability to generate immense liquidity while maintaining a disciplined cost structure that is rare in the capital-intensive world of aviation. By stripping down the revenue into its constituent parts, cost of goods sold, administrative expenses, and taxes, we can observe a business model that is engineered for high-margin efficiency and resilience against both local currency volatility and global economic shocks. In the foundational years between 2006 and 2011, ASUR operated primarily as a custodian of the Mexican tourism industry. Revenue grew steadily from 2.6 billion to 3.8 billion peso, reflecting the increasing global appetite for the Riviera Maya. During this phase, the financial management was characterized by predictability. COGS and SG&A expenses were kept tightly correlated with passenger traffic, ensuring that operating cash flow consistently hovered around 40 to 50% of total revenue. A defining characteristic of ASUR's financial identity is the complete absence of research and development costs. Unlike technology or pharmaceutical sectors, the airport industry relies on physical utility and location. By avoiding the speculative spending of R&D, ASUR has been able to channel almost every peso of operational gain toward either tax obligations or capital reinvestment, creating a very clean flow from top-line revenue to bottom-line cash. As we move into the second decade of this analysis, specifically the 2012 to 2017 window, the table illustrates a massive step change in the company's scale. This era was defined by geographic diversification as the company looked beyond the borders of Mexico. The acquisition of the San Juan Airport in Puerto Rico and the strategic entry into the Colombian market via airplane transformed the company's revenue profile. By 2017, total revenue had leaped to 8.7 billion peso. What is most impressive about this expansion is that despite the increased complexity of managing international operations and navigating different tax regimes, the conversion of revenue to operating cash flow remained exceptionally high. The year 2020 stands as a testament to the defensive strength of the airport concession model. When the pandemic halted global travel, many airport operators faced liquidity crises. ASUR's revenue did contract, falling to 7.2 billion peso. The flexibility of its cost structure allowed it to mitigate the impact of reduced aeronautical fees. Furthermore, the recovery was faster than almost any other airport group globally. Because Mexico maintained open travel policies, the flagship Cancun hub served as a vital gateway during a time when most other international hubs were shuttered. The current era, spanning 2022 to 2025, represents the golden age of ASUR's financial performance. As global travel entered a revenge tourism phase, the company capitalized on its upgraded retail and commercial offerings. Non-aeronautical revenue, the money generated from duty-free, luxury retail, and VIP lounges, became a primary driver of margin expansion. By 2024, revenue reached 28.5 billion peso. This massive liquidity provided the war chest necessary for the boldest move in the company's history, the 2025 acquisition of CPC Aeroportos. The 2025 data line is particularly critical as it shows a massive spike in capital expenditure to 7.8 billion peso. This figure represents the massive cash outlay required to finalize the acquisition of 20 airports across Brazil, Ecuador, and Costa Rica. By deploying its accumulated cash into these high-growth Latin American markets, ASUR has effectively secured its revenue pipeline for the next 30 to 50 years. The Brazilian assets, in particular, offer a demographic and economic scale that complements the tourism-heavy Mexican portfolio, providing a more balanced mix of business and leisure travel. The financial history of Grupo Aeroportuario del Sureste, ASUR, over the last 2 decades provides a fascinating study in corporate evolution, moving from a conservative, cash-rich domestic operator to an aggressive, multinational infrastructure powerhouse. When examining the company's capital allocation from 2006 to 2025, a clear narrative emerges. A long period of internal fortification followed by a series of transformative international leaps. This journey is marked by a unique, disciplined approach to the balance sheet, where the company utilized its robust free cash flow to reward shareholders consistently while waiting for the perfect moments to deploy massive amounts of capital into strategic acquisitions. In the early years of this period, from 2006 to 2011, ASUR was essentially a cash cow with a fortress-like balance sheet. During these 6 years, the company operated with virtually zero financing debt. The capital allocation strategy was incredibly straightforward. The company paid out a significant portion of its earnings as dividends, usually keeping the payout slightly below the annual free cash flow, and allowed the remainder to pool in cash and short-term investments. By the end of 2011, the cash position had grown to 2.4 billion peso, providing the company with a significant war chest that would soon be put to work. The first major pivot in this narrative occurred in 2012. After years of operating solely within Mexico, ASUR made its first significant international move by securing a stake in the San Juan Airport in Puerto Rico. This acquisition was a signal to the market that the company was ready to expand its horizons. Interestingly, even with this move, the company maintained its zero debt status, choosing to fund the expansion through its accumulated cash reserves. This disciplined approach allowed ASUR to enter the international arena without compromising its financial stability, a hallmark of the management team that has persisted for decades. Following a few years of digestion and steady dividend growth, the company reached its most transformative period in 2017. This year saw a massive leap in both ambition and financial complexity. ASUR executed a significant acquisition strategy in Colombia, taking control of Airplan and its portfolio of 6 airports. The company fundamentally changed its capital structure, moving from a debt-free entity to carrying 11.5 billion peso in financing debt. This was a calculated move, as the company's free cash flow had jumped, providing ample coverage for interest payments. Despite the sudden increase in leverage, the company did not pause its dividend program. Instead, it continued to increase payouts, signaling total confidence in the cash-generating power of the newly acquired Colombian assets. The years leading up to the global pandemic showed a company in peak operational health. From 2018 to 2019, ASUR focused on deleveraging and maximizing the yield from its now diversified portfolio. Dividends reached 3.0 billion peso annually, and the company began to rebuild its cash reserves. When the pandemic hit in 2020, the strength of this capital allocation strategy was put to the ultimate test. The post-pandemic recovery from 2021 to 2023 was nothing short of extraordinary. As travel demand exploded, particularly in the Mexican Caribbean, ASUR's free cash flow reached unprecedented levels, soaring to 12 billion peso by 2023. During this time, the company's cash and short-term investments grew to a staggering 13.9 billion peso. Rather than rushing into small deals, the company waited, allowing its balance sheet to expand until it was capable of executing a truly massive strategic shift. The climax of this 20-year history arrived in 2024 and 2025. This period represents the most aggressive capital deployment in the history of Latin American aviation infrastructure. In 2025, ASUR completed the acquisitions of URW Airports and CPC Aeroportos. These deals gave the company a foothold in the U.S. retail market at hubs like LAX and JFK, while simultaneously adding 20 airports across Brazil and other regions. To facilitate this, the company took on a record financing debt. However, the most shocking figure in the 2025 data is the dividend payout. This was driven by a massive, one-time strategic dividend intended to return excess capital to shareholders before transitioning into the next phase of the company's life as a higher leverage, high-growth multinational. The leadership of Grupo Aeroportuario del Sureste is characterized by long-term stability and significant insider alignment, anchored by its chairman and CEO, who have both been with the company since its early privatization days. Adolfo Castro Rivas currently serves as the chief executive officer. He has been a fixture at ASUR for over 26 years, originally joining in January 2000 as the chief financial officer before being elevated to the CEO position in 2011. Ownership of the company is dominated by Fernando Chico Pardo, the chairman, who holds a massive 29% stake through his various investment vehicles, ensuring powerful insider control and alignment with growth strategies. Institutional investors play a critical role as well, holding approximately 54%. The remaining 17% of the shares are held by the general public. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. The future of ASUR over the next 2 decades is inextricably linked to the successful retailization of its airport assets and the maturation of its newly acquired international portfolio. The bull case represents a future where ASUR becomes the dominant airport platform in the Western Hemisphere. The primary catalyst here is a sustained boom in Latin American middle-class travel, combined with a highly successful transformation of U.S. airport retail into a luxury mall model, as cash flow surges, funneling all excess liquidity into annual dividend growth. With an operating margin hitting 68% due to scale and automation, ASUR finds itself with enough dry powder to execute another 55 billion peso transformative acquisition in the next 20 years, potentially moving into the European or Asian transport sectors. In the base case, the company enters a phase of operational optimization. Following the massive debt-funded expansion of 2025, the narrative shifts toward deleveraging and steady organic growth. Revenue expands at a 7.2% CAGR as the Brazilian and Colombian markets modernize, and the U.S. retail concessions at JFK and LAX provide a high-margin, dollar-linked revenue hedge. In this scenario, dividends grow steadily, and the company spends roughly 30 billion peso on tuck-in acquisitions or terminal expansions to maintain its competitive edge. Conversely, the bear case accounts for a world of persistent inflation, higher interest rates, and regulatory interference. If the Mexican government imposes more restrictive concession terms, or if the Brazilian economy faces prolonged stagnation, ASUR's 3.5% revenue CAGR would barely track with inflation. In this reality, the high debt taken on in 2025 becomes a drag on the business, forcing the company to prioritize debt service over growth. CapEx would be restricted to mandatory maintenance, and dividend growth would stall significantly. In this scenario, the company effectively ceases its acquisition strategy to defend its core Mexican Caribbean assets, which remain the primary source of survival cash flow. In the bull case scenario, we assume the following: revenue growth at 10.5%, operating cash flow margin at 68%, CapEx growth at 8%, stock-based comp growth at 0%, dividends growth at 14.2%, stock repurchase growth at 0%, acquisition spending in the next 20 years at 55 billion peso. Stock repurchases assumes price-to-sales ratio of 5. With this discounted at 10%, dividend model yields $360 worth of value per share in 20 years, $670 in 30 years, and $1,120 in 40 years. In the base case scenario, we assume the following: revenue growth at 7.2%, operating cash flow margin at 59%, CapEx growth at 5.5%, stock-based comp growth at 0%, dividends growth at 9.2%, stock repurchase growth at 0%, acquisition spending in the next 20 years at 30 billion peso. Stock repurchases assumes price-to-sales ratio of 5. With this discounted at 10% dividend model yields $220 worth of value per share in 20 years, $318 in 30 years, and $410 in 40 years. In the bear case scenario, we assume the following: revenue growth at 3.5%, operating cash flow margin at 51%, capex growth at 2%, stock-based comp growth at 0%, dividends growth at 5.2%, stock repurchase growth at 0%, acquisition spending in the next 20 years at 5 billion peso. Stock repurchases assumes price-to-sales ratio of 5. With this discounted at 10% dividend model yields $153 worth of value per share in 20 years, $192 in 30 years, and $216 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.